The Florida condo market is experiencing something nobody saw coming just a few years ago. What used to be considered bulletproof investments are now turning into financial nightmares for thousands of owners. We're not talking about minor price adjustments here. These are devastating collapses, the kind where people are watching their life savings disappear in real time. Welcome to Discover Us Housing. If you want the unfiltered truth about what's really happening in America's housing markets, you're in the right place. Hit that subscribe button because today we're exposing the 10 Florida cities where condo values are absolutely cratering in 2026, and the reasons behind it might shock you. Let's start with number 10, Sarasota. This Gulf Coast jewel was supposed to be untouchable. You had pristine beaches, wealthy retirees, cultural attractions, and those stunning waterfront towers that seemed to print money for anyone lucky enough to own a unit. Developers and real estate agents repeated the same line over and over. By now, because Sarasota only goes up. Well, that story just got demolished by reality. Units that were changing hands for $600,000 back in 2022 are now sitting on the market at $420,000. And even at those reduced numbers, they're not moving. That's a 30% wipeout in less than 4 years. But the price crash is only part of the disaster. Inventory has exploded. We're seeing more than 60% more listings compared to the peak buying frenzy, which means sellers are competing against each other in a race to the bottom. Here's where it gets truly brutal. The actual cost of owning these condos has gone completely insane. Insurance bills that used to run around $3,000 annually are now hitting $9,000 or more. Association fees have doubled or tripled in many buildings as boards scramble to meet new state mandates on reserves and structural inspections. Owners are getting slammed with $1,200 a month in HOA fees alone before they even think about their mortgage or property taxes. Then the special assessments start rolling in. $20,000, $30,000, $50,000 bills to fix concrete, replace roofs, or bring buildings up to code. For retirees on fixed incomes, this is absolutely catastrophic. They can't just conjure up that kind of cash. Some are taking out loans they can't afford. Others are panic selling at massive losses, and many are just frozen, hoping somehow the bills will stop coming. Investors aren't doing any better. Rental yields that looked attractive at 7% have collapsed to 3% or lower once you factor in all the new costs. Short-term rentals are flooded with competition, and occupancy rates keep dropping. The vibe on the ground has completely shifted. Real estate agents who used to close deals every week are now going months without a single sale. Developers are offering discounts and incentives just to move inventory that was supposed to sell itself. Banks have turned cautious too, demanding bigger down payments or outright refusing to finance older buildings with questionable reserve funds. Coming in at number 9 is Bradenton. This city always played second fiddle to Sarasota, and for a while that worked perfectly. You got similar Gulf Coast amenities, just without the premium price tag. It felt like the smart money move for people who wanted Florida coastal living without overpaying. That advantage has completely evaporated. Condos that climbed close to $400,000 during the frenzy have crashed down to $280,000, another 30% decline. Listings have multiplied fast. Over 1,500 condos are sitting unsold right now, and that number keeps growing. The math simply doesn't work anymore. Monthly association fees that used to be $300 or $400 are now hitting $500 to $900. Insurance has more than doubled from around $2,800 a year to $7,000 or higher. When you add in mortgage payments at 7% interest rates, total monthly costs are pushing past $2,200. For a lot of people, renting is just cheaper and way less risky. Investors are bailing out in waves. Short-term rental returns have collapsed as occupancy rates sink into the low 50s and nightly rates keep falling. People who signed pre-construction contracts at peak prices are now refusing to close, walking away from their deposits rather than take ownership of a money-losing asset. The stream of retirees moving down from northern states has slowed to a trickle. They're running the numbers and realizing Florida's sunshine tax doesn't make sense when you compare total costs to places like the Carolinas or Tennessee. The result is complete gridlock. Flippers are stuck paying HOA fees on empty units they can't unload. Developers who broke ground 2 or 3 years ago are sweating through higher construction costs and interest payments while sales crawl. Number 8 takes us to Daytona Beach on the Atlantic side. This place built its whole identity around being the affordable beach option. Spring break, NASCAR, oceanfront condos that didn't require a fortune to own. It was supposed to be middle-class coastal access without the Miami or Gulf Coast price tags. That promise is falling apart fast in 2026. During the boom, prices in many buildings hit the low 200s. Now those same units are trading closer to 160 or 170, marking drops between 20 and 30%. Inventory is piling up with identical floor plans competing against each other for the same tiny pool of buyers. The real shock is in monthly costs. Insurance that used to cost $2,000 a year has doubled, or worse, in older waterfront buildings. HOA fees that felt manageable are now running $500 to $900 a month as boards build reserves and comply with tougher safety standards. Special assessments for concrete work and structural fixes are hitting hard. Retirees and snowbirds on tight budgets are getting crushed. Some are cutting back on everything else just to keep up with the bills, while others are listing at losses just to escape the next round of charges. Associations are caught in an impossible spot, chasing down delinquent owners while trying to keep up with insurance and maintenance demands. Investors are drowning too. Daytona's short-term rental market is saturated with condos competing against hotels and each other. Occupancy is down, prices are soft, and long-term rents aren't climbing fast enough to cover the soaring costs. Just walk along the beach and you'll see the damage. Buildings that used to turn over quietly are now plastered with for sale signs. Units sit for months, fall out of contract during inspections, and get relisted at lower prices. Lenders are getting pickier with older properties that have thin reserves or unresolved engineering reports, which shrinks the buyer pool even more. At number 7, we've got Orlando. The theme park capital was always considered a safe bet. World-class attractions, constant convention traffic, a growing metro population, it all added up to reliable condo demand, or so everyone thought. That confidence is crumbling. Prices that hit $310,000 near downtown and resort areas have dropped to $230,000, about 25% below peak. Active listings have almost doubled as thousands of condos flood the market. The cost equation is completely broken. HOA dues in most buildings now run between $600 and $1,000 a month. Insurance has roughly doubled since 2021. A typical two-bedroom that used to cost $1,800 a month to own is now demanding $2,600 once you add in the mortgage, taxes, insurance, and fees. Tourism hasn't saved the market. The rush into short-term rentals overshot demand by a mile. Complexes near International Drive and tourist zones are jammed with units, all fighting for the same travelers. Occupancy in some buildings can't even hit 50%, and nightly rates keep sliding. Add in Florida's new inspection rules and reserve requirements, which are triggering $10,000 to $20,000 special assessments in older buildings, and lenders have backed way off. Financing is tougher for properties with weak reserves or questionable reports. Even cash buyers are demanding steep discounts to offset the risk. The street-level reality is impossible to ignore. Blocks that were covered in sold signs back in 2021 now show endless rows of stale listings. Owners who banked on short-term rental income are learning the numbers don't automatically work. Orlando proves that even tourism powerhouses can't beat basic math. When ownership costs outpace both local incomes and rental returns, something has to give. Number 6 is Cape Coral. During the pandemic years, this canal maze became the poster child for the Florida fantasy. Waterfront condos with boat docks and sunset views felt like guaranteed wins, the kind of assets you could buy and forget about while they appreciated. That dream is dead. By 2026, the story is brutal. Median prices that reached $340,000 have crashed to $240,000, a 30% freefall. Inventory has nearly doubled as new listings hit faster than buyers can absorb them. Insurance is the main killer here. Premiums that averaged around $3,500 back in 2020 have exploded past $10,000 for many waterfront units. Monthly HOA fees between $600 and $900 are standard now, and special assessments for flood mitigation, roofs, and structural work regularly hit $20,000 to $30,000 per unit. For retirees who paid cash, the ongoing costs now match or exceed what a mortgage would cost. Investors counting on vacation rentals are bleeding money. Occupancy in some complexes has dropped below 45%. The lingering effects of Hurricane Ian plus updated flood maps have spooked buyers. Condos in high-risk zones or older buildings barely get any interest even after major price cuts. Making things worse, several private insurers have completely pulled out of the region, forcing owners onto expensive state-backed plans. You can see the shift everywhere. Canals that used to see bidding wars are now lined with for-sale signs staring out at empty boat slips. Developers who rushed to build during the boom are stuck with half-finished projects and buyers trying to back out of their contracts. At number 5 is Jacksonville. This Northeast Florida city always positioned itself as the stable, boring option. Big footprint, diverse economy, military presence, lower cost of living than South Florida. It attracted buyers and investors looking for Florida exposure without the volatility. By 2026, that stability narrative is cracking. Median condo prices that touched $230,000 at the peak have fallen to $180,000, more than a 20% drop. Listing inventory has surged about 60% compared to boom times. The numbers are upside down. Monthly HOA fees averaging $400 combined with insurance near $4,000 a year and higher mortgage rates are pushing ownership costs towards $1,700 a month. Comparable rentals are going for $1,400. That gap makes the choice pretty obvious for most people. Out-of-state investors from pricier markets drove a lot of the price run up. Now they're heading for the exits. Over a third of active listings in key areas showed documented price cuts. Downtown and riverfront projects that were supposed to spark urban renewal are now leaning on concessions just to fill units. What stings is how fast the mood flipped. For years, Jacksonville marketed itself as a steady, low-drama market. People believed its mix of logistics, military, and corporate jobs would shield it from the chaos hitting other Florida cities. Higher rates, insurance shocks, and tighter lending standards on older buildings proved that wrong. Today's buyers are asking about reserve funds, inspection histories, and insurance exposure before they even tour a unit. Jacksonville still has real economic strengths, but the idea that it was immune to Florida's condo collapse just isn't true. Number 4 brings us to West Palm Beach. For a minute there, this city really leaned into being called the new Miami. Luxury towers, high-end branding, waves of wealthy newcomers pushing prices to levels that seemed impossible a decade earlier. By 2026, the limits of that luxury story are showing. Median condo values that peaked above $400,000 in 2022 have slipped to $300,000, a 25% decline. In some premium buildings, individual units have fallen even harder from their original asking prices. The drop in value is painful enough, but it's the explosion in ownership costs that's really changed everything. Insurance in some coastal towers has tripled, hitting $12,000 a year or more. HOA fees in top buildings have doubled to around $1,000 a month. Unexpected special assessments of $30,000 to $40,000 per unit are becoming routine as boards rush to meet state requirements and fix years of deferred maintenance. Short-term rental economics are broken too. Occupancy in many luxury buildings has fallen below 50% while nightly rates soften. Lenders are hesitant to finance units in towers with maintenance backlogs, weak reserves, or heavy investor concentrations. The visible changes around town are stark. Towers that used to glow with near full occupancy now show long stretches of dark balconies at night. Agents quietly admit that wealthy buyers are offering 20% below asking and getting accepted. International money that used to flood into Palm Beach County is now way more selective, favoring newer developments with solid engineering and insurance profiles or skipping the region entirely. Number 3 is Tampa. When you look at Tampa's skyline with all those cranes and rising towers, it still looks like a city on the move. For a long time, that image represented unstoppable momentum. By 2026, though, the reality is way more complicated. Median condo prices have dropped from around $310,000 at peak to $230,000, about 25% down. In premium waterfront areas, units that sold near $600,000 are now struggling to get $400,000. Total inventory has ballooned to levels not seen since the last major crash. Ownership costs have spiked hard. Monthly HOA fees in many towers have jumped from $450 to $1,000. Insurance near the Bay has roughly tripled, with some properties facing premiums near $9,500 a year. For conventional buyers, total monthly costs can easily top $2,400. That's a serious burden in a metro where median household income sits around $70,000. The short-term rental escape hatch isn't working either. Airbnb occupancy in many Tampa buildings is running below 50%, and nightly rates have been slashed to stay competitive. In some neighborhoods, nearly 40% of active condo listings already show price reductions. Psychology matters now as much as fundamentals. During the pandemic surge, Tampa pulled in remote workers and transplants fleeing high-tax states, creating a narrative of permanent growth. That confidence has faded. Construction timelines are stretching and new developments are getting delayed as builders adjust for higher insurance, pricier financing, and slower pre-sales. Flood zone changes, stricter inspections, and tighter lending are adding to buyer hesitation. People are wondering if they're buying a stable asset or stepping into quicksand. Tampa still has job growth and population momentum, but its condo market can't ignore reality. Prices and costs eventually have to line up with what people actually earn. Number 2 is Aventura, just north of Miami. This city built its brand on upscale living without the drama. Waterfront views, high-end shopping, gated security, steady international, and out-of-state money. Even when other markets wobbled, Aventura was seen as the calm, stable choice. By 2026, that certainty is gone. Condo prices that peaked near $600,000 in 2022 have slid to $440,000, roughly 27% down. Listing inventory has jumped about 80%, with both older waterfront towers and newer mid-rises carrying units that sit unsold for months. Rising costs are driving the panic. Insurance across coastal Broward and northern Miami-Dade has roughly tripled since 2020, often passing $12,000 a year for buildings near water. HOA fees in luxury developments now routinely exceed $1,200 a month. New reserve rules are triggering special assessments ranging from $25,000 to $60,000 per unit, especially in older towers. Buyers from New York, Latin America, and Europe who treated Aventura condos like safe deposit boxes are now recalculating. When total ownership costs exceed rental income potential, the safety narrative falls apart fast. Short-term investors relying on seasonal rentals are hurting too. Softer demand, tighter regulations, and heavier competition have pushed occupancy below 50% in some buildings, even as nightly rates drop. Developers who sold South Florida as a stability play are quietly pivoting. Closing credits, rate buydowns, and temporary HOA coverage are increasingly common just to move remaining units. Agents say negotiations are slower, buyers more cautious, and the expectation of automatic appreciation is completely dead. Aventura remains wealthy and visually impressive, but 2026 has proven something critical. Even in luxury markets, soaring insurance, heavy assessments, and weak returns can destroy the foundation. And finally, number 1, Pensacola. Topping our list is this Gulf Coast city that was marketed as the attainable Florida dream. Military presence, beautiful beaches, small city charm. It was pitched as the safer, more affordable coastal option compared to Florida's bigger, flashier metros. That sense of security has proven completely false. Condo prices that peaked around $310,000 in 2022 have crashed to $215,000 by 2026. That's a 31% collapse. Inventory has exploded nearly 90% year over year in some segments. Buyers have endless choices while sellers have lost all leverage. Ownership costs have skyrocketed. HOA fees that used to be $400 a month now commonly hit $800. Insurance for waterfront properties has tripled in many cases, pushing past $7,000 annually. With mortgage rates near 7%, total monthly costs easily exceed $2,200 in a city where median household income is only around $60,000. That gap is crushing. Investors who saw Pensacola as a reliable cash flow market are hemorrhaging money. Short-term rental occupancy has dropped below 50% in many complexes. Nightly rates are down and long-term rents aren't rising fast enough to offset insurance, taxes, and fees. Properties that look dependable on spreadsheets are now losing money every single month. Statewide reserve requirements have piled on more pain. Older buildings that delayed maintenance are facing special assessments from $20,000 to $40,000 per unit for structural repairs and reserve rebuilding. Some owners can pay, others list at losses, and some just walk away entirely, leaving associations scrambling to collect and lenders quietly blacklisting whole buildings. Pensacola's collapse stings because it was sold as the middle ground. Not speculative like Miami, not tourism-dependent like other Gulf towns, just a stable, livable place by the water. In 2026, that story doesn't hold up anymore. Florida's condo market isn't going through a normal correction. This is a full-scale reckoning. From the Gulf Coast to inland metros, from Jacksonville to Pensacola, the pattern repeats everywhere. Insurance costs explode. Aging buildings face strict safety rules and expensive repairs. HOA fees and special assessments climb while borrowing costs surge and investors flee. This isn't a typical cycle where prices dip then bounce back. It's a structural reset where the true cost of condo ownership in Florida is being recalculated in real time. If you're thinking about buying into this market, slick marketing and pretty photos won't save you. You need to dig deep into reserve funds, insurance histories, inspection reports, local income levels, and long-term climate risks. Ask yourself whether the people who actually live and work in these cities can still afford the units filling these towers. That's the real question nobody wants to answer. Thanks for watching Discover Us Housing. If this opened your eyes to what's really happening, smash that like button and subscribe for more no-nonsense coverage of America's housing markets.